It's funky out there. It's funky. There's some crazy stuff happening. A lot of good news. Let's run through a really quick brief. I'm not going to keep you long. Brief market update. What's going on? I'm going to shrink my head here and let's talk about it. So today's Bank of Canada rate announcement. Rates held. Okay, rates held. The overnight rate held at 5%. What does this mean? Means the cost of borrowing is still high, still the highest it's ever been. But the good news is the narrative, or I guess the tone that the Bank of Canada had, they're still maintaining their confidence in rate reductions this year. Most economists are anticipating 4 rate cuts, which will probably happen quite rapidly throughout probably late spring, summer, and fall into the end of the year. So we know that the rate cuts are coming, and that confidence has brought back a lot of buyers into the market. So the price points can't really change until the rates change. But what's shifting positively is the narrative, okay? So the narrative that rates will be coming down. It's good news, okay? But it's just a little too soon to consider rate cuts because inflation's not coming down as quickly as we need it to, right? The target rate for inflation is around the 2% mark, and we're still hovering around 2.9%. So why? There's some geopolitical turmoil in oil producing countries causing the price of oil to stay a little high. And actually, funny enough, it's a funny inverse relationship, but mortgage interest is causing inflation to stay high. So the solution is in the problem and the problem is in the solution. So it's kind of the chicken or the egg. Something has to happen first. Okay, so let's have a look at this. We see the inflation coming down rapidly, okay? And you can see these kind of trends inversing, and they naturally should have a symbiotic relationship, okay? So this should have a positive correlation. And since maybe January 2022, we've seen a drastic inverse relationship between inflation rates and the Bank of Canada's interest rate. So as we see that inflation come down, because what happens is the overnight rate, or the Bank of Canada's rate, follows the inflation rate. So as inflation comes down, the Bank of Canada's overnight rate will come down and try to align. Okay, so just a little visual for you. Now, in terms of February stats, I don't know where to put my head here. This is a full slide. I'll move it around. Anyways, here, we don't need my logo. Boom, you know who I am. In terms of February, based on this positivity, based on the rate holds, we saw transaction volume pick up immensely. Okay, so actually we saw 18% growth in transaction volume, meaning sellers are selling and buyers are buying. This is good news. The people are out there. Okay, average prices are higher than pre-pandemic levels, but we're still far away from those 2022 peaks, if you will. Okay, kind of that January 2022 peak that we saw. We're still far off from that, but we will climb back. We will climb back toward it. It's just not as rigid or as steep as it was. Obviously, there was other factors at play, kind of a black swan event, you'd call it, unprecedented event in the pandemic, in COVID. Obviously, we've talked about this at length, but when things get tough, obviously the government printed a lot of money, causing inflation to run wild. We had 3 options to curb inflation: reduce interest rates, which we did and couldn't reduce anymore; increase outputs, which we couldn't do because borders were closed; and 3, ramp up inflation like crazy. Okay, so we ramped up inflation to devalue debt, to devalue the government's debt. And now we have to kind of correct that. And if we correct too quickly, that's where we see recessionary signals. And we're not seeing that. We're not seeing that. We're avoiding the recession. It's going to be a soft landing. If you're reading news, if you're paying attention to the market, you've probably heard that term, soft landing. Okay, what does that mean? It means that we're going to come out of this nicely. We're going to come out of this really in good shape, okay? And that's because we're not rapidly decreasing rates, seeing some positive signals in inflation, okay? But the main takeaway here is that the buyers are back. Buyers are buying, sellers are selling, and things are happening again. We were kind of on hold for like 18 months, right? No one knew what was coming. Now, when I say the confidence is back, look at these trends. This is the average sold price. So again, trending upwards throughout 2022, and then we saw that decline as of, I'd say, January maybe early February of 2022, as soon as the Bank of Canada described that they were going to start hiking rates, obviously to curb inflation. So 2023 was riddled with rate hikes, okay? But we kind of saw transactions start to pick up, funny enough, in the spring of 2023. A little bit of confidence came back in the market. We could blame seasonality. We could blame some of the tone and tonality out there that rates were anticipated to start decreasing. Inflation was coming down. Things were working. But again, we can't flip the switch. This is a longer term recovery. But we still see, what we see is in the short term, we see transaction volume increasing and we see average sold price increasing. So I would say that the worst is behind us and the best is yet to come. Okay, so I can confidently predict we're going to see an increase in transaction volume and a huge increase in pricing. But that huge increase in pricing is not going to happen in the next 6 months. It's going to be gradual over the next 3 to 5 years. So the confidence is there. The predictability is back. That's a big one. And we're going to see these positive trends continue. So there's a lot of conflicting news out there, if you will, okay? But the narrative has shifted hugely in the media to exude confidence. So we're seeing the trends coming back. The buyers, the sellers, the economists, the banks, they're taking note of these trends, okay? We're seeing signs of life in the market. We're seeing inflation coming down. We're seeing building permits actually increase, which is great, which is going to help supplement the supply issue, which I can talk about the supply issue for hours. If you want to call me, I'm happy to talk to you about it. But basically, at a high level, it's impossible to solve the supply issue, especially in Toronto proper, okay? There's just not enough relevant land, okay, or developable land. That's a tongue twister, developable. There's not enough developable land, okay? So supply is going to be an issue going forward. We're seeing some builds coming, but we've got 500,000 immigrants that have come to Canada in 2023. 2024, we're on pace for 500,000, and 2025 as well. Aggressive immigration targets just to kiss over 500,000. What does that mean? It means a lot of them are coming to Ontario and a lot of them are coming to the GTA. So housing is going to get more scarce with demand increasing and supply it's an impossibility for supply to maintain or keep pace with demand. So basically what happens from here, I'm going to go big again because why not here? I will be the crystal ball. Basically, what's going to happen from here? Well, with predictability, with confidence in markets and what's to come, we can confidently assess the future of the market. And what I see coming is a rate cut probably as early as late April, early May, okay? And what that's going to do is cause a stir, cause a flurry, because it's going to set the tone for what's to come. It's going to show, hey, these economic policy, the deployment of economic policy is working. It's having the intended result on the economy. It's allowing us to have a soft landing in our economy. And this beast that is real estate, you can't stop it. You can put in place whatever you need to do. You can try with economic policy and making it more difficult to borrow. But ultimately, with the lack of supply in our market and the insatiable demand, over the next 3 years, we're going to see some pretty positive price appreciation. And again, a small number, I mean, standard average, I'd say, is about 5-6%. We will probably be in line with 5 to 6% appreciation in asset prices over the next 3 to 4 years, with the confidence in the market and declining interest rates, probably landing around the 3.5 mark in the next year and a half, maybe 2 years. And that's just going to continue to propel the activity and the transaction activity. And I mean, you know as well as I do, my clients look around, look in your backyard, look in your pockets, in your areas. There's not enough land to build on, but people are coming. And what that does is it just adds propulsion to the value to the real estate market. So what would I do? I would jump in earlier than later if you're considering an investment. This is the time. This is that, hey, it's been 18 months of hey, we're getting there. We're there. Okay, we're there. This is the recovery and the worst is behind us. So Options, one, you wait for rates to decline and you make your moves then. The only thing that's going to change is you're paying more for asset class. If you're buying and selling in the same market, who cares, right? Life goes on. We do what we have to do, buying and selling in the same market. Only difference is if you're downsizing, you're giving up higher cost of debt. If you're upsizing, gap between asset classes is shrinking. Investors, you're getting compressed asset prices right now because interest rates are higher. Okay, and when interest rates start to decline, the natural relationship is that the asset prices will appreciate. So if you want to invest, if you're looking to get into the market, first-time buyers, this is it. Okay, you've maybe got 2 to 3 months time before things start to go wild. And again, wild in terms of transaction volume, not prices going nuts. Okay, but it increases competition in the transactionary market. So for sellers, things are looking really good for you this spring. Come April, come May, things are going to be great. And buyers, buy. If you don't own something already, then this is your opportunity to get in the market. So as always, I'll leave you with that. I told you it would be brief. I'm sorry. I can talk about the market forever. So if you want to chat more, give me a call. If you're thinking pre-con, it's a great time for pre-con. There's some phenomenal incentives in place right now. The developers are trying to get rid of some excess inventory that built up over that 18 months of slowness. Sellers, great window here with activity picking up. Buyers, you want to try to beat that rush. And that's it for me. So have a great day. And as always, we appreciate your business and we appreciate your ongoing referrals. So thank you. And don't hesitate to call me 647-991-2432. You know my number. So give us a call. Thanks a lot.